Hey everyone, I hope you're all doing well out there. My name is Dan Westfall. I'm a certified financial planner. I run the company Client Focused Financial. For those of you that are new to watching these videos, the reason that I put this video together each month is to give my clients the straightforward information about what's going on in the stock market and the economy, and ultimately how that affects their money that's invested with me. So what I do is I use a lot of charts to go over really what's going on in markets. And I think it's a good visual. So then that way people can get a good understanding of exactly the concepts and things that I'm talking about and put in something a little bit more tangible to it. So first chart that I have here is just a chart of the S&P 500 and the rate of return since the beginning of this year. Last couple of weeks, we've had really good surge back higher. Markets are just under 12% returns here for the year so far, which is really good. Anytime you're in double-digit rate of returns for the stock market, you're in a really good spot. Obviously, we're still only in August right now. I'm shooting this August the 4th, so we still have some time until the end of the year, but definitely a good sign overall. We've been going through really this sideways market, and you can see in this chart since basically mid-May, where we've been in what's called a trading range, where a stock, or in this case, an index, is just moving sideways. It's not really going up dramatically. It's not really going down dramatically. So it'd be nice to see if we can break out of that trading range here, maybe as the last few months go on. But either way, still really good to see overall. A few of the changes that I've made within portfolios. One of the things I've gotten really good feedback on from clients out there about is just going over the changes that I'm making within portfolios, because you all get confirmation statements, whether you actually open them or click on the link or whatever it is. But I know when you get them, you're probably like, I don't know what Dan's doing. So that's what this is for, so you understand what I'm doing and get just a real 30,000 foot overview of why I'm making those changes. And then this is ultimately kind of some updates on some of those changes that I've made in the past here. So one of the bigger changes that I had made here earlier in the year was cutting out the technology sector and replacing it with semiconductors, which is really just a subsector of technology. Semiconductors are the chips that go into whatever you're watching right now. If you're watching me on a computer, a phone, a tablet, there's a semiconductor, which is the brains behind that piece of technology. So semiconductors had gone up a lot because of the movement in AI, and really just the potential shortage around not having enough of these semiconductor chips to produce all of the things that AI is, and companies are hoping that AI will produce. So one of the things that I had made this trade on was back in, looking at this chart here, back on April the 10th, there was a move higher off the bottoms at the end of March. And the momentum in semiconductors had really started picking up. That's when I made that trade, was right in that time frame, basically cutting out all of technology and adding the semiconductor position, which has done really well over that time frame. While they've both gone up a lot, semiconductors had gone up a lot more. It's come down a big amount here over the last month and a half. So one of the trades that I had actually made going back into mid-June, semiconductors had become, for the more aggressive part of the portfolio, it had become about 43%, where originally it was 35%, because it had gone up so much just over a couple month period. So what I had done, because I didn't want to completely cut the position out of there, I still think that semiconductors is going to move higher. It's consolidated a lot here over the last month and a half, coming down. And even more recently, there's been a big hedge fund that was over levered in AI related companies, which part of them are semiconductor stocks. And they lost 67% in July, which they then had to sell a lot of those positions on the way down, which forced a lot of those stocks lower over kind of the mid-July timeframe. Now that's out of the way. There's definitely some potential tailwinds because of that, because you're going to get more investors that are now buying in at these lower levels because of that. So chart that I have here, though, looking at semiconductors versus healthcare. Back on June the 10th, I'd cut about 13% of the semiconductors, basically just locking in those gains at that time. I had cut those off and then added that to the healthcare sector, which at the time healthcare had been trending. You can see here the healthcare sector since that time is up 6.5%, while semiconductors, they went up initially another like 15% before now dropping to being down about 5%. So off their more recent lows, which that big drop kind of mid-July timeframe from July 20th through the 28th timeframe was because of that hedge fund that I mentioned that made Wall Street Journal headlines. It was a really big deal. So that was definitely a big reason why semiconductors had dropped off so much. But that was one of the updates on a more recent trade that I made there that I wanted to kind of go over with you guys. One of the things that, and this is just more something as I'm talking with people, whether it's current clients, I'd seen a lot of my Pennsylvania clients in mid-July when I was up there on tour with a bunch of my boomers up there. So I get a lot of feedback from people and I hear a lot of things. So when I hear things multiple times, I know that it's not just a one-off type thing. So when I hear those types of things, I want to share that with you guys and really my take on those perspectives. Or perspectives. One of them that I had gotten questions about, and this is actually more from prospective clients that I had come across, where they had asked me about bonds being in portfolios, because typically an investment advisor, especially for somebody that's more conservative, is going to have a big mixture of bonds held within a portfolio. I've looked at bonds for those of you that have worked with me for a handful plus years. I haven't really used bonds in portfolios outside of a small allocation in short-term bonds for really going on 6 years now. So reason for that is just because I think there's just a better place and a better way you can manage that part of the portfolio for risk. Because the reason that you have bonds in a portfolio is to reduce the risk of the stocks. So stocks are the part that they make more over time, but what no one wants when they need to withdraw money or when they're just getting closer to retirement or just want to be more conservative, no one wants those big drop-offs that stocks bring. If you're younger and you have more time to work with, where if you have a 5-10 plus year track that you have until you're going to end up withdrawing money, there's not really a whole lot of reasons to have a whole lot of money more conservatively invested. But you may be somebody that's just more conservatively minded, so you don't want to have as much in stocks. So I use options-based strategies versus bonds. A chart I have here is showing the 10-year Treasury rate of bonds as of August the 5th here. They were at 4.63%. This is a chart going back all the way into the early 90s, showing the rates on that. The 10-year Treasury is the benchmark for interest rates. So when the 10 years going up, that's going to move, your car loans or your mortgage rates, like they're all moving in line with the 10-year to some degree. So savings on a CD at the bank is going to be somewhere in that, in that realm, or moving in a similar direction. So what we've seen since 2020 is this huge spike higher and then a consolidation in rates, just because the Fed stopped raising interest rates in 2023. And the 10 years just gone sideways in that time frame, and more recently gone up just because of concern of potential inflation picking up again because of the Iran war and just other factors out there. So where I look at this from a portfolio management standpoint is that 4.6% is really good if you're talking about a guaranteed super safe part of a portfolio, which is what a 10-year Treasury bond is guaranteed. But if I'm looking at that where I'm like, well, if we're going to leave the money in there for 10 years, theoretically with a 10-year Treasury, that's what you're trying to do. If you're going to leave it in there for that time frame to make that 4.6%, you might as well have it in something that at least is going to participate a little bit more with the upside. And that's where I use the options-based strategies that get a little bit more on the upside. They mitigate that risk of the stock market drop to some degree on the downside. And that's why I'm using those in replacement of your typical bonds. So corporate bonds, high yield bonds, I would look at as even worse than just using a 10-year treasury because those aren't guaranteed. At least a 10-year treasury is actually guaranteed. Most advisors don't even want to won't use a 10-year treasury because they would rather, put your money in some corporate bond or high yield bond because they think that it's going to get these higher returns and they're trying to squeeze this little bit of return out with, but they're taking the risk by doing it. And it's unnecessary risk, especially, and this is for any advisors out there that are watching this. I'll cue you in on some game here. There's options-based strategies out there that will reduce the risk a whole lot more and give your clients a lot better upside. So, if you want to talk to me about that, love to chat with you. I'm looking at hiring a junior advisor, so if you're in the St. Pete area, love to chat. So, another thing that I've come across with people is just them talking a little bit more about. This isn't really current clients. This is more prospective clients where when I'm talking with them, they've been talking with other investment advisors that are just kind of spewing their side of how they think a portfolio should be managed, and really they come to me, and then I have kind of set them straight on really how things work. So one of them is dividends and creating a portfolio that is built around dividend yields. This is just a cool chart. Thinking on this topic, I pulled the dividend yield up for the S&P 500 going back through 1995. We're actually at one of the lowest levels since the early 2000s for dividend yields on the S&P 500. It's right at about 1% right now, which is very historically low. Typically, though, the S&P 500 doesn't really pay a lot in dividends, but this is definitely a time frame where they're paying a lot less. The reason I bring this up at all is because some people will want to have their portfolio set up for income because they're withdrawing for retirement purposes and they want to have a high income or dividend oriented portfolio. Really, it's only part of the equation. The other part of the equation is like, well, what's the fluctuation of the position doing itself? Because if you have a dividend that's paying you 6%, I used to always use AT&T as an example for this because AT&T stock always paid like a 5 or 6% dividend yield, but their stock price had dropped in half at one point. I'll pull up a chart of it here. I don't know where it is right off the top of my head, but it hasn't performed well. I know that just without even really looking at it. It hasn't performed really well over the last 10, 15 years. But people have invested in it because they get a 5 or 6% dividend. What in the end of the day, it's really about the total return of what's the fluctuation with the position plus the dividend. And I'd rather have no dividend in a position where the position goes up, 10% versus a position where you get a 6% dividend and you end up having a negative return because the position goes down. Which results in the total return being obviously less than 6%. So that's one of the things that I know for my current clients, not really a typical topic that you guys care about because you see your portfolios going up and everything's really good in that way. For those that are out there shopping advisors and interviewing advisors, look for somebody that's working or managing a portfolio through total return, because if they're selling some dividend strategy, really they're only looking at one side of the equation and missing out on the bigger picture, because at the end of the day, you care about your bottom line of the portfolio, not just a dividend stream that you get from a portfolio. That's only part of the equation that's actually important. So those are the charts and just some of the topics that I had here for the month. If you have questions for me, obviously reach out, call, text, email. If you have people you think would be interested in having a deeper conversation with me, introduce us through text message or just give them my contact info and have them reach out. I'd be more than happy to help them out. But I appreciate you all taking the time to check me out. Until next time.